All right, good morning, everyone. Thanks for getting up bright and early with us this morning, and welcome to day 2 of Future Proof. Welcome to the beach stage and to our panel on the new frontiers of asset management. My name's Sean. I'm with ETF.com. I'm editor-in-chief there, and we have a great panel lined up for you guys today. I'm super excited. I think we're gonna have a lot of fun, actually, because it's a fun topic, right? We're talking about innovations in the ETF space. We'll be talking about some trends, tailwinds, headwinds, opportunities as we move into 2024. So welcome, everyone. ETFs have literally revolutionized the marketplace, right? As we all know. $6 trillion now in AUM in the US, become go-to for financial advisors, just essential in the backbone of client portfolios and helping clients get to better outcomes. They had a banner year last year in terms of inflows. We saw the second largest annual haul ever, and in a down market is pretty impressive for ETFs. RIAs, financial advisors, are a huge part of that success and that momentum. And now global assets are projected to top 10 trillion globally this year. So a lot to talk about, but enough with the numbers and the projections, right? Let's get down to it. As I mentioned, we have a great panel lined up today, probably the best group of experts we could have found to talk about innovation in ETFs. So quick introductions. We have Hamilton Reiner, Managing Director with JP Morgan Asset Management. Welcome, Hamilton. Jennifer Granchillo, CEO of Engine Number One. Welcome, Bob Elliott, CEO of Unlimited ETFs. Good morning, Bob. And Ryan, panel head of Kaiju Worldwide. So good morning, everyone. Thanks for being here. So let's get kicked off. I think the two hottest trends, undeniably, that we've seen, right, are the rise of active management and AI, right? We're not getting out of 2023 without a discussion of AI on a panel. But I think we can talk about the intersection of those two things, which is kind of really interesting. I know Hamilton, he's leading one of the most popular actively managed ETFs of last year with JEPI, and Jennifer has an active ETF as well, and Bob and Ryan both work heavily in AI and how that's kind of building some of these strategies. I know AI is taking up a lot of the quantitative roles of building these strategies. So let's kick it off. I know active has been around now for around a decade or so, more probably than that. But we've seen really increased popularity now, right, this year and into last year. I think they make up 6% of the assets, but brought in 30% of inflows this year. So maybe we'll start with you, Jennifer. Where do you attribute that rise to in active management this year?
Yeah, so from an active management perspective, and from a full disclosure perspective, my background is I was there when we founded iShares. So I spent all those years convincing everyone that ETF and passive were the same thing. But then no problem. But if you think about portfolios today, so if you think about your portfolios for your clients today, many of you have gotten rid of kind of bad active managers, maybe use a lot of passive. And so I think the opportunity is, one, don't equate the ETF wrapper with passive. The ETF wrapper is a cool and beautiful thing where you can always look through on holdings, and you can do a great job on taxes if you are working with a manager that does that. So wrapper's great. And then if you go back to your portfolios where maybe you have a lot of index today, if you think about how to drive value for clients in trends, so what we do at Engine Number One is we're looking at what are mega trends. So we're pretty sure that you're good on mega tech stocks in your core portfolio, but if you think about the energy transformation, not green energy, but the transformation of our whole system, big old economy companies, that's going to lag the index. And so there are huge long-term transformations or trends, and we think that you need to be active. It's complicated, it plays out through time. So these are places where we think, you're maybe not as equipped to do micro niche theme trading. It's better to use an active manager to go after the big trend. I think that's one area. And then in certain market conditions or parts of the portfolio, I think as active managers, it's our responsibility to tell you, and Engine Number One, we do this for Net Z, which is transform climate, and reshoring of supply chains, which is SUP. It's our job to tell you where they fit in the portfolio. It doesn't have to be 100%, but what percentage of the core portfolio should you be tweaking differently or managing more actively? So that's how I would think about it, and I think it's a huge opportunity for people that already have asset allocation in a core portfolio to lean into active where it makes sense.
Yeah, no, definitely well said. And maybe Hamilton, we could jump over to you.
So I echo a lot of what Jennifer just shared with us, but there's a couple of things I would say. active managers stopped being as passive around the ETF wrapper. The ETF wrapper is wonderful. The transparency, the tax efficiency, the intraday liquidity, the fees. So I think actually it's not about the ETF wrapper, it's the delivery mechanism that's so wonderful, and I think active managers have gotten a lot more comfortable with one thing in particular, and that is transparency. Historically, active managers have been in the scenario of like, I'm happy to manage your money in an ETF, mutual fund, or SMA, but I'm not going to tell you what's in there. Not really a transparent or investable asset. So I think the comfort around transparency, because a great product with great outcomes that's illiquid is neither great or transactable. So the transparency helps in the liquidity. The other thing I would say is that the thing that has changed that has made active 30% of flows, even though 6% of the assets, is it's now fully embraced by active managers because of all the wonderful things Jennifer said about the delivery mechanism. And there has been this silent period from active managers and letting passive providers just own the narrative. It's cheap, it's passive, you'll never have to apologize for being in a cheap passive ETF. But the fact is, the other wonderful attributes around the ETF wrapper makes it a ridiculously amazing way to help clients find and own your strategies.
Yeah, well said. Ryan, you want to take it?
Just from my perspective, maybe the acceptance of that increased agility within the portfolio management sphere is taking on new shape now. I mean, as Hamilton said and Jennifer said, that you had traditionally a lot more passive active management, and so the results didn't bear out with the promises and decreased transparency. Now you have more active managers, you have better performance, and so I think that the awareness and benefit of that is really bubbling back to the surface.
Well, a big part of the reason why actively managed strategies and more sophisticated actively managed strategies can come into the ETF wrapper is the meaningful regulatory changes that occurred a few years ago that basically radically changed the framework in terms of using the ETF wrapper as a sophisticated asset manager. I come from the fund space. I was in the hedge fund business for 20 years and never even thought that a hedge fund wrapper or that an ETF wrapper could be the most efficient way both for investors as well as operationally to run our product. But when I learned about how much flexibility exists in the product, it really transformed my thought on it. And so now we're able to run sophisticated hedge fund replication strategies in that ETF wrapper because we can run long and short and leverage just as long as we maintain, frankly, common sense institutional quality risk controls that make sure that we don't get out of bounds with what we're doing. And I think that is increasingly we're going to see managers getting comfortable with the transparency, which is an important thing, and recognizing that the ETF world is the most efficient way to run sophisticated strategies. And the reason why that is because the tax efficiency, if anything, is actually better for actively managed strategies with moderate turnover than it is for traditional index strategies. And so you get the execution ability, you get the flexibility, and you get the tax efficiency. I mean, what is there not to like about an actively managed ETF these days?
Well said.
Sean, just one other thing
Sure.
I'd say though. I mean, if I were starting the asset manager of the future, I mean, ETFs are wonderful, but it's not for everything. And I know you're ETF.com, but if I were creating the asset manager of the future, it would be like Chipotle. Choose your protein, choose your base, choose your delivery mechanism. So whether it be a burrito and rice and chicken or whatever else. So it's actually along the left side, it's like what type of delivery mechanism, and along the top would be what type of strategy do you want. So I actually think that SMAs belong in people's portfolios, mutual funds, ETFs. It's not just ETF only, it's just what best suits your investment style, your clients, what have you. So I think it actually is not just about the wrapper. Any wrapper works, whatever suits investors.
Yeah, no, well said. I'm more of a quesadilla guy myself when I hit Chipotle. But that was a great analogy. And talking about the active versus passive kind of debate, right? I think the big knock on active, or what you might hear from more of the passive people, is about performance and over long terms and how some things might outperform or not outperform. And I'm wondering if there's any kind of truth or how that kind of plays out and how you all kind of think about that. I know I saw some data just today from Morningstar that 57% of actively managed funds outperformed passive counterparts in 2022. So I don't know if that's narrative is changing, or who do you believe, who's doing the data, who's doing the research, but how do you guys think about that? And maybe we'll start with you, Bob.
Well, I think the basic question, whenever you think about active management, is that trade-off between the quality of the alpha that manager is bringing against the costs that they're charging to deliver that alpha. That's the basic trade-off every time. And so when we talk about, typically when we talk about the fact that active managers often underperform their passive benchmarks, the issue is not that they can't generate alpha. The issue is the fees are too high. And that is a critically important trade-off that you have to think about anytime you're evaluating an active strategy. And I think one of the things, just going back to what I just said, that has really changed by bringing the sort of active ETF infrastructure in place is that those sorts of strategies that are, say, sophisticated enough to run in, typically 2 and 20 style structures and fund structures, many of them, not all, but many of them can be brought into the ETF style wrapper, right? And they can be run in a much more efficient way. And what that means is that for most investors, we're increasingly seeing their ability to access better alpha, better active management in a way that's cheaper for the operator, for the issuer to execute. And that combination of things means that we're likely to see better outcomes for investors net of fees when it comes to active management than we've seen, with the old traditional mutual funds or 2 and 20 fund products.
Yeah, I mean, maybe just to build on that, sort of this question of active versus passive and what's driving all the active flows. I think some of it is just you have firms that were active firms that woke up and realized the wrapper is cool. So some of it is just the same old strategy wrapped in the new wrapper. That's where a lot of that growth is coming from. But I also think we're in a different market. So from a portfolio construction perspective, you start with something today. You're in a market with higher rates. Cost of capital is high. There's going to be dispersion between different companies and their performance given that higher cost of capital. I think it's a very interesting time to look at where you can use active in terms of kind of manager skill, manager selection, whether that's a model or whether that's a fundamental PM team. So I think it's a good time to look at active for that reason. I think particularly from an engine number one perspective, there are these mega trends that are complicated, and it's not a theme that's going to come and go. We're moving to decarbonization. The world is changing. It's deglobalizing. These are huge, huge, huge decade-long shifts. Those are really interesting places to be active as a part of the portfolio. And then there are a lot of active tools. So there are tools. You have buffer tools. You have leverage tools. And so, I mean, I think the world is very broad in terms of replacing core, taking some of core, putting it in active, and then using all of these tools for people that want to hedge and want to take very, sort of short-term views on the portfolio.
Sean, I think it's even more simpler than people make it out to be. If you actually look at the headlines, what the headline says is the average active manager underperforms passive. It's like saying the average quarterback is not as good as Patrick Mahomes. I mean, the fact is if you're going to go active, you have to do the work. You have to draft correctly. You have to do the due diligence. You have to find managers. It never says the top quartile of active managers beat passive by 200 basis points per year. It's average, and averages are half are going to be better and half are going to be worse. So if you do your due diligence and you just like drafting, and you find the right players and you put them into your portfolio, you will have success over passive, because one of the benefits of active is alpha. Right? If you think about a little bit of alpha, 100 basis points of alpha per year over 20 years on average compounds to thousands and millions of dollars. So doing your due diligence and finding those managers that have skill is incredibly important. And then the other thing I would say is that when it comes to passive, what do you get with passive? You get 100% of the upside and 100% of the downside. Nothing wrong with that. Net of fees, which are near zero in many cases, no problem with that. But with active, you have a chance for asymmetry, a little bit more of the up relative to the down, the ability to have a better up and down capture. What is one of the best ways of compounding wealth over time? Making a little bit more on the upside and losing a little bit less on the downside. So I think when the narrative has been up until now, until sort of like the Empire Strikes Back or Active Strikes Back, has been average versus passive, and that's not the facts. Not you have to draft correctly.
Yeah, interesting for sure. Anything to add?
I would just mostly echo what Bob had to say. We come from the 2 and 20 space as well, 3 and 40 space, and so, had to say it.
I'd like 3 and 40. My God.
Well, you
And you're up here.
Your alpha's got to be pretty incredible for 3 and 40, right?
run an AI
I
shop
guess
for
the
long
people
enough.
invested in Millennium are learning that right now.
You're
and you can pull
0.74?
that in. Who will pull that? Well, no, whoa. Too far. Let's not dive into the dirty edge, right? I mean, I like to think of it as sort of a less intelligent Jim Simon with, no beard. Something like that.
Do you smoke?
No, I don't. Although after all the one-on-one meetings yesterday, I guess you can't, if you couldn't tell, maybe it's a bit gravelly, but that spares you from the normal nasally tenor of my voice. But coming from that space and late to ETFs, like we've been here for like a year and a half. Passive was an odd duck for us to gain comfort with anyway. It just seemed like, okay, why would you not be focused on an actively managed ETF? It was a big learning curve for us, and when we started building in this space, the first thing that we realized was it's not a lateral transition of strategies. Like you can't just port over what you're doing in a lightly regulated or less regulated space into a 40 Act space, and it's like, okay, we'll just turn that into an ETF. I mean, we tried. The very first thing we did was say, okay, let's take our fully risk-defined, market-neutral strategy. We'll just wrap that up as an ETF and we'll sell it to the market. And it was, unfortunately, just too complex for market makers to work with. That was our first bottleneck was, yeah, that sounds great, and nobody's going to be able to effectively price that intraday. And you're saying, well, we can, and we could give you the information. No, you can't be passing the information to us. So, from our perspective, it's like, okay, so how do we use the strategies that we've used on the other side for so long within a wrapper that's more beneficial to a broader investment base, remove some of the cavitation in P&L that more risk-tolerant investors are okay with, and provide a reliable product with, as Hamilton said, enough transparency to gain comfort with it in this space. If we can do that, then I think we make a far better case for that style of actively managed ETF over passive. But it's new, and given that we do all of this with artificial intelligence, it's really new here.
Yeah, I mean, and I think that speaks to the trade-off between the quality of the alphas and the fees. So maybe in the active ETF wrapper, you have a bit, you do have to navigate the constraints that exist in the ETF space, which mean that you can't, run highly quantitative intraday trading strategies and things like that. But the question is, if you're transitioning, so maybe you get a little worse alpha than the absolute best 2 and 20 managers, but you're shifting from paying 3 and 40, right? 700 basis points of fees to now being able to pay under 100 basis points of fees, let's say. And that's the most important thing. Remember, alpha is uncertain. Fees are certain, right? And if you can bring down the fees, the probability that the alphas that are being generated by the active managers that you're investing in, the probability that they deliver above those fees goes up considerably. And so that's the trade-off. You're right, you're not getting Millennium in the ETF wrapper, but you're also not paying 3 and 40 with a 5-year lockup. And that's the trade-off.
Yeah, and I'd add that one of the things I see as sort of the advisor community not struggling with, but because it's so early, is trying to figure out for some of these strategies, do you take it out of your alts bucket? Do they already have a liquid alts bucket? Or do you go over to the core? I mean, for engine number one, you could go over to your core public markets today. And like Hamilton said, you're finding places where you want to get more alpha. And so I think that's one of the questions as the market develops too, is should you be having less private and traditional alts and moving it to kind of these liquid alt vehicles? And as you go back and look at your core public portfolios, how much active do you want? Where do you want it? Who do you believe in?
And the only other thing I'd add is that Bob makes a good point on taking more sophisticated, traditional hedge fund-like products and put them in an ETF wrapper. But I would say for my strategies, and I think for Jennifer's as well, there is no sacrifice of alpha. It's just a different delivery mechanism. It's the same exact product. because we can run it in a mutual fund SMA or an ETF identically. So there is no sacrifice in alpha. It's just, in many cases, better tax efficiency, more transparent, lower in fees, same alpha. Same net alpha, because it's not what you make, it's what you keep.
Yeah, and maybe we'll dive into client portfolio construction a little bit. I think that's an interesting place to go, especially if we have a bunch of, I'm sure, RIAs and advisors, and they kind of want to listen to that. I think maybe we'll start with you, Jen, and kind of dive more into what you were talking about which buckets they do want to come out of alternatives, or how, if you do want to find a little bit more alpha or take on a little bit more active strategies, what should advisors be thinking about in terms of the holistic view of their clients?
Yeah, I mean, I would say if you start with a passive portfolio, and that's where you are today, you'll find that if you take 20% of that, and I'm talking about equities for a minute, and maybe you can talk about the bond and fixed income side as well. If you think about the equity part of portfolio, if you start passive, if you take 20% of that and take a lot more active risk, it's not actually increasing the overall active risk in the portfolio. And so that's what I see people doing. And just be very focused within that active bucket on, what do you believe is going to drive value through time. And so some of these mega themes belong in there, and it may be that a lot of people looking to invest in companies that sell AI, so that's a theme. And it may be experimenting with some of the liquid alts in that bucket as well. So that's what I see on the equity side.
So just to recap, you're saying take 20% from passive, move it into active, and you have the same amount
and
of
then
risk?
If you're already in an active core, it's sort of again, take some percent of that large blend core and tilt into some of these major themes, which they're not represented in a lot of what you have as your large mid-cap. Your large mid-cap is 25% plus skewed towards mega tech. And so you're going to miss some of these big themes if you don't take some of that out and lean in, and active's a good way to do that.
Sure. Hamilton?
So when I think about my strategies, my personal report card, there's 5 things I expect for myself. Better Sharpe ratio in the market, very good income. One of my strategies, 7 to 9 JEPI. JEPQ is 9 to 11. Number 3, positive up-down capture. Number 4, anywhere from, let's call it 30 to 40% less volatility and beta in the market. And number 5, very good total return. So adding my strategies tends to help the expected total return of your portfolio with the same volatility and risk profile. And I think that's the most important thing when I think about portfolio construction. Everyone in the audience here is not an asset allocator in my mind. You're risk managers. Your clients give you their money so that they can actually end up in a really good spot, but your job is to hold the steering wheel, if you will, on how much risk they're capable of taking and willing to take. So adding active or adding, my strategies, which are, more equity income-oriented strategies, is not about adding risk to your portfolio, but being more efficient in your risk allocation. So if I do all the things that I say I'm going to do, and I have, and I hope to continue to do, you take a little bit of your equity and a little bit of your fixed income, and using Jennifer's analogy, a moderate investor, which is, let's call it 60-40, strategies like ours end up being 50, 30, 20, 50% in stocks. Find your favorite managers, 5 your favorite passive, whatever it may be, a little bit of value, a little bit of growth, because neither one's always going to work. 30% in income, and I use the word income because for the first time in my investing career, you don't need duration to get income. You could be at the short end of the curve or the back end of the curve. And then 20% in other strategies that maintain that volatility risk profile of your asset allocation, but give you incremental better Sharpe ratios, positive up-down captures. And those types of additions to your portfolio end up in a smoother ride, more efficient use of your risk budget, and better client experiences. And that's how we've seen success when people utilizing my strategies.
I think in the AI space, you sort of have your 3 buckets that you could allocate to. You can go with thematic exposure to AI. You think that this technology has a bright future. I don't really follow the ETFs that are providing that today, because one, they're like a subset of the Qs, and if you just did a liberal sprinkling of the Qs and added SMH,
they got a balloon over there, be nice.
Yeah, exactly. You got your thematic exposure. It's also sort of weird that the manufacturers and managers of those ETFs don't use AI in the selection or management process. So you think that it has a bright and shiny future, but no, we don't use that technology. A little weird. And then you have AI supported or assisted ETFs. So you like the manager, you like the manufacturer, you like the trading ideology, whatever it is. And you understand that the application of the technology is going to do some of the heavy lifting for them. It's going to provide a culling or filtering mechanism. And then finally, you have what we do, which is endpoint decision making by the AI, curated and directed. So you think that the technology itself has room enough to run to trust it with some portion of your wallet, that it's capable of making lightning fast, well risk mitigated decisions, and you want to dip your toe in that bucket. And there's room for all three to try out in terms of allocation, but really I think it boils down to an advisor's underlying ideology more than anything else. Which one are you most interested in, and which one are you most comfortable with and not comfortable with?
Yeah, for sure. Bob?
Well, all of you sitting out here as advisors, you basically, your job is to figure out a way to do better than 60/40, to deliver your clients a more consistent return stream than 60/40. And there's basically, if you look across the universe of assets that you can invest in that complement 60/40, we'll call these alternative opportunities from the traditional portfolio. There's basically 3 assets that can meaningfully improve your risk-return profile. That's gold, commodities, and diversified alpha. And what we're talking about here, in a lot of ways, are opportunities to get access to that diversified alpha, right? The challenge with that is twofold. One is, are you getting good alpha relative to what you're paying? And 2, are you diversifying it, or are you concentrating it? And all too often, any particular alpha strategy, even the best managers in the world, even the best alphas in the world, underperform for meaningful periods of time. And so the key to successfully bringing that into your portfolio is diversifying your managers and diversifying your strategies so that you're not overly reliant on one particular type of alpha that's coming into the portfolio. And so the opportunity there, the opportunity to improve diversification is pretty incredible. Just those 3 pieces, a 10% allocation to gold, a 10% allocation to diversified commodities, and a 10% allocation to diversified alpha, could improve the Sharpe ratio of your clients' portfolios by something like 50%, just from those 3 changes, and maintain similar levels of return, and still have something like over 90% monthly correlation to the 60/40, so that you don't have too much peer risk. Now think about that. 3 simple changes to improve the outcomes of your clients by 50%. That's how you do it.
Interesting. Yeah, I think I just learned something. I'm going to go change my IRA when I get home. I would say we're at Future Proof. Why not? I don't know if we can do Q&A, but if you guys do have questions, Q&A, shout them out if you're brave enough. I don't know. I didn't ask John if we're allowed to, but please feel free to. So let's move to AI then, what we were talking about a little bit more, and how some of the best use cases that we can find in AI. Obviously, there's thematic as a bucket, but then the companies that are really using AI to make these investment decisions. I did an interview a few years ago, I think it was with Fidelity, and they were using AI to comb through satellite images of oil tankers to see how high they were off the level, to look at oil's commodities futures and things like that. So there's really incredible use cases. But Ryan, why don't we start with you? I know you're very heavily using AI. What are some of the use cases that AI is being used to create some of these strategies?
Well, I think if we're talking about where it's most effective, it's in pattern recognition, like as technical as you can possibly get. Order flow predation, and sure, it has the ability to pick up on fundamental changes in underlyings by finding the patterns that accompany those changes. But it's really right now, from our perspective, limited in its broad capacity to heavily systematic pattern-based application when it comes to endpoint decision making. I mean, it can do a lot of work for you in terms of heavy lifting from a filtering capacity, but it's never going to be able to, I mean, it's a dangerous thing to say never, but it's never really going to be able to manage like a global macro fund because it doesn't understand context. It sucks at nuance. And so it has no idea what the socioeconomic fallout is going to be from some geopolitical decision halfway around the world. Like, there's no capacity for that. And there's so much noise for it to consume if it was even going to attempt, that the output would be basically useless. So, what we see it used for at its best is highly short-term, the patterns that it's able to predate on and the outcomes it's able to predict are most accurate in the short term. For us, it's 1 to 7 days, the average being 3, which is basically the same as Renaissance Technologies, 8-day hold on average. It has no idea where this underlying or this sector is going to be in 90 days. Like, that's just not possible. There are too many variables, and it would be best guess at that point. So really, the performance comes from the short-term application, and I think that that will be borne out as the data becomes greater and more available.
So maybe just a follow-up, and then maybe we'll just head down the line. But Ryan, so what are some of the specific things that you are looking at to find patterns and to kind of to use AI to bring out some of that alpha?
Please tell us the secret sauce of how you find these things. Okay, so I think I can. Our chief compliance officer is not in the audience, so I can probably do this very cautiously and not give too much away. The way I look at, or the way that we've always looked at resultant price action is that it's a symptom, right? It's the cough, right? So you have no idea what caused the cough, right? You have a cold, you have COVID, you have lung cancer, you're not sure, but volume is the underlying illness, right? So if you're going to examine anything, you're examining generally time series patterns and volume, and that is going to result in what happens to the underlying, the sector, whatever. And it doesn't matter what's driving it. If this is an HFT predating on liquidity pockets and voids that are going to create a short-term shift and then reversal, it's predatable. If it's a stock entering a giant institution's buy zone, it's going to create a pattern that's predatable. And these things are highly reliable and repeatable. And despite the fact that there are systems on the other side of this trying to hide this behavior, if anything, these systems are very good at identifying each other. And when you have this, even on the generative side, when you have these systems that are creating original art, part of the process is one system creates the artwork, and the other system is tasked with determining whether or not a machine created the artwork. And 99% of the time, it can tell that a machine created. And the 1% that it can't, that ends up on somebody's wall, or Christie's auctions it for an unfortunate $475,000. I'm fairly certain Jim Simons bought that one. But otherwise, that's what you're looking for. You're looking for predatable patterns that you can find in data, and not on the NLP side, because there's so much noise there that it's not possible for social sentiment to be accurately discerned by these systems.
Interesting. Hamilton?
So we are significant users of AI as well, but we use it different than Ryan does. So when I first started in the industry, what was the first thing that my mentor told me? Find your one publication and read it every day, whether it be the FT, Investors Daily. Does Investors Daily still exist? Wall Street Journal, some blog, maybe listen to the Animal Spirits guy, whatever it may be. Find your one financial publication and read it every day. And so when we think about using AI, we don't look for the picks and shovels. That's a different type of strategy. We're using it to actually do fundamental bottoms-up stock analysis. So if someone asked me to do a write-up of a company, what would I do? I'd read as many research pieces as I could. I'd talk to as many people as I could. But using AI, neural networks, and large language models, we're able to do it significantly better, faster, and smarter than me at scale. Just to bring that to life, every night we look at over 45,000 publications in 90 countries in 40 languages. Pretty remarkable. If every JP Morgan asset management person just stopped what they were doing and read, it would take us 20,000 days to consume what we consume in a single night. And when thinking about investing, what drives performance of stocks? It's really fundamentals. And if I could have more information to consume at scale, we think we can make better fundamental decisions. And we're looking out 3 to 5 years, so we're looking a little farther out than you. And we are now looking at how we put these stocks together. Because more information garnered at scale, we think we can make more robust investment decisions. And so our strategy, NASDAQ Equity Premium Income, right now is the largest active user of AI in the ETF landscape with over $5 billion, which is pretty remarkable.
Wow. We'll have to add ETF.com to your publication reading list.
It's probably there.
And Jen,
Yeah. So I think at engine number one in the ETFs, or when our deal closes, what will be the TCW ETFs, we're very similar to what you talked about, which is we're looking for like 3 to 10 year major trends. We're investing that way. We don't think AI can do that, but it's an incredibly important input from a research perspective. And so AI you need a hypothesis, you need frameworks, you need models, you need to test them and train them. It's expensive. It's like there's a lot of precision that goes into that. And so I think as that grows, there's going to be tons of applications for us as we think of ourselves as fundamental investors, but we use a lot of data. And to the comment on like satellite data, when we look at the Transform Energy Fund, where we're looking for alpha over railroads and transportation and agriculture and energy producers and all the inputs there, we're using a lot of data and a lot of research to try to get as smart as we possibly can on who wins and who loses and what's causal, and trying to link our point of view on how companies behave and choices they make now and capital allocation decisions to kind of who wins over that 3 to 10 year horizon. So incredibly important, but can't work just with a push button in our industry as of yet.
sure. Over to you, Bob.
Well, as a person who's been building systematic investment strategies for more than 20 years, like I've seen all sorts of techniques, let's say. In a lot of ways, like, what is AI? Well, first of all, AI is a whole bunch of things, right? Ranging from large language models to highly quantitative technical models, right? So AI doesn't really mean anything. You have to get under the hood to understand what is the actual tool and what is the use case. And there's a lot of instances where, particularly in higher frequency, high volumes of data, where certain AI models make a lot of sense because they're engaged in that pattern recognition. There's enough sample size for it to make sense. There's other areas, as you said, like global macro, where there's been 7 cycles since 1950, where like AI on 7 data points is no good, whereas AI on 1 trillion pictures of cats is good, right? And so you pick, as a systematic investor, you have to pick the tool that fits the problem. And so that's the key thing to be looking at. And for us, I think in the hedge fund replication space, what is neat is that there has been a lot of innovation in the tooling relative to when even this idea started. So if you go back 20 years, Andrew Lowe, he was running rolling regressions over 3, 5, 10 years to try and understand what hedge funds were doing. Well, fast forward to today, the world is very different. We can now run million simulation Bayesian models on portfolio positioning, in the matter of a few minutes, right? A much faster, more efficient, more accurate way of being able to understand what these managers are doing, and in a way that allows us to sort of capture in a much more tactical sense how they're shifting their positioning. But the way you do that is not by just applying whatever model exists, just picking anything out of the air and applying it. It's looking at the problem, understanding the best strategies and techniques that are available, and consistently applying and evolving, bringing those great techniques to the fore. Ultimately, any use of this technology is an investment decision, and that's why it's very important that to recognize that it's not like just some technologist off the street can just say, well, I just create AI and it just does an investment strategy. Anything that is actually going to be robust and successful requires decades of deep experience having built this, understanding the limitations of the technology, and applying the right tools to the right problem to solve the investment problem at hand.
And unfortunately, we can't share any of those models, which is one of the core challenges that we have with transparency in AI in this space, is that it's the regulations that we're subject to in the 40 Act are fantastic and assistive in terms of building trust for a new technology within an active wrapper. But what would be really assistive is if we could share the mathematically validated AI outputs that we have. And we're not allowed to because the regulators can't tell the difference between a quantitative backtest and a mathematically validated AI model. And there's a reason for that. They look basically identical, right? If I put them out in front of you, it's a bunch of charts and grids talking about performance of a product or strategy that didn't exist during the period in which you're testing it. So they lump them together and they say, yeah, you can't use that. But a quantitative backtest is, human-derived for starters, You can't selectively forget that which you know, so there's a subconscious bias, which is why your strategy is always overfitted, and then on execution, it's always off model. So quite rightly, the regulators look at it and they say, it's misleading, you can't use it. But as opposed to a quantitative backtest, it's a strategy test. Mathematically validated AI model test is a behavioral test. So yeah, fine, you've trained the machine on this historical information, but then when you test it, you're rewinding the markets, and you're actually adding an amnesiatic component. You're wiping out the machine's memory of anything that it's ever seen and leaving only intact the decision-making capability. So when you play the market forward at the tick level in real time, it's acting as if it was there in the moment. It has no idea what's coming. It, in fact, doesn't even know it's watching historical data. It thinks it's watching a live market. And you can run sample size iterations of that 60 million different times. So when you bring a product like this into a live environment, the executions are 100% of the time on model. Like, there's nothing surprising about the performance that we see going forward ever. So we are in early stages trying to lobby regulators, which is probably not something that we're going to have any success with. I've been given like a 1% chance of success here, but it's worth at least having the conversation and saying, look, we want to be able to share this because this is in the name of transparency. Like, you want to know how we do what we do there, that's how we do it. And they come back with, of course you want to share this, it makes you look awesome, but it doesn't make us look awesome all the time. Right? You can see the cavitation in the performance. You launch one of these new products, you run it for 2 years, and you happen to get a sympathetic market condition, then advisors and investors are going to over-allocate to this, not knowing what you know to be absolutely certain would be the performance in a variety of different market conditions that you're not allowed to share. So I don't know how we change that, but we can start by saying please, I guess.
No.
We have a slightly different approach in the fact that generative AI has actually changed when we think about fundamental investing and using AI, because there's a transparency as what feature, what reason, what publication, what piece of information or multiple pieces of information as to why we like a security or a bunch of securities. So it's a slightly different approach and a slightly different output that we have that I'm not sure we have a more sympathetic regulator, but it actually gives us the transparency to understand why we're slightly overweight a name or slightly underweight a name and what piece of information, because I think that from our lens, as I said earlier, fundamentals drive long-term performance, but more importantly, I think where the challenge in AI and we have to take control of the narrative is these are not self-driving cars. These are cars that actually may have a lot of information and maybe could be self-driving, but there's somebody in the driver's seat to ensure that it stays on the road just in case a bad piece of information comes from left field or right field, or maybe a cat crossed the road, or one of the 10 million cats you talked about, Bob, whatever it is. There has to be somebody at the helm of investing. You just don't plug it in and then go to future-proof for a couple days.
Hang out in California for a while. How about, we actually have a question from the audience. So I guess we'll shift gears here. If you guys do have questions, we have about a little over 6 minutes left. So please, I think you can go into your app and put those. They'll come up right on the screen here for us. We have one. If shifting away from the 60-40 portfolio for other thematic or alpha strategies, which bucket would you take from?
Yeah, I mean, I maybe would go back to what I said on that before, which is I think for a lot of advisory practices, you already have a system and you already have a way that you construct portfolios. So first of all, it's our responsibility to hear how you already construct portfolios to kind of tailor recommendations. People handle defensive, they handle income differently, depending on how you have your portfolio constructed. So with that disclaimer, I would say on the equity side, what you have in your large mid blend today, you are going to miss major opportunities. I would take 20% of that and I would point it towards some of these really long-term trends.
I would add incrementally is there's no such thing as a 60-40. 60-40 is a risk profile. 60-40 is a overall client comfort with an investment portfolio. I feel comfortable that I'm going to have about a 12 volatility and a long-term expected return of 7-8%. So it is an outcome based upon a risk profile. So I would actually say there's no such thing as a 60-40. The 60-40 is a moderate investor. So given that it's a moderate investor, there's a certain risk profile that helps them get invested, stay invested. So when you add a strategy, it's about staying consistent with that risk profile. So if that 60-40 is in the 60 of very conservative, high-quality names that have less beta in the marketplace, then you could actually, in that incremental thematic alpha or strategies like mine, maybe take it actually a little more from your fixed income. But if you have a high-growth, high-tech, more spicy equity portfolio, then you're probably going to take a little bit more from your equity portfolio. So I think, our North Star, your North Star is how much risk are my clients taking, and don't jeopardize or violate that when you add a strategy. But more importantly, allocate in a way that keeps them consistent with where you started as far as their investment philosophy and process.
Anything else to add?
I would just say for most folks, when you're allocating to alpha, you want to think about what your overall risk is in alpha relative to your risk in betas. And so what that requires is that you start, to the extent that you're looking at primarily absolute return or liquid alt strategies, you can pretty much say that basically most of that risk is in the alpha side of things. As you start to look at, I'd say, what I'd call constrained alpha opportunities, which are alphas in a particular asset class, it's very important to disambiguate basically how much of the returns that you're seeing are driven by the manager's incremental bets relative to the benchmark and how much is really just the overall benchmark. And so that sort of work should get you to a point where something like 10% makes sense in most people's portfolios of your risk is driven by alphas, and something like 90% is driven by well-constructed betas. You put that together, and you can get a pretty darn good Sharpe ratio at an overall portfolio level.
So anything to add, Ryan? Or?
Oh, you don't want to ask me. I mean, I would just say most of it, right? I mean, that's coming from this space. Like, we don't run a 60-40 split. And I mean, when Hamilton said a 12-all, I saw Bob's face like noticeably get tighter. So, yeah, I would just go with the conservative advice came from this side of the panel for sure.
I like the 60-40 doesn't exist, because you hear 60-40 is dead, it's alive, it's this, and now it doesn't even exist. So I like that. We took it to the next level. So we have about 2 minutes left, so let's do a quick lightning round. Predictions for 2024. Give one prediction. What do you think is going to happen next year? And it could be anything. We'll start with you, Bob.
Just at the time that everyone's given up on recession, here it comes. Are you prepared?
Man, what a downer. All right, Jen? It's probably true, but...
I also think we're going to see AI come into how you engage with your clients. Watch the space on the distribution side. It's going to make your lives much easier on reporting, portfolio analytics, and storytelling.
Earnings are going to be higher in 2024. 7 names work this year. What if the other 493 begin to work? All-time highs are 6% from here. There's a ton of money on the sideline. Clients have 50% more cash than average, and markets tend to go in the direction that unfortunately hurt the most people the most. So I'm saying higher.
I think you're going to see more AI products come to market, and optimistically, I hope with greater transparency allowed us by the regulators. All right, that's probably not going to happen. But since we're going with predictions at that scale, that's going to be mine.
My 2023 prediction was Bitcoin ETF, so I'm getting closer. I'm almost there. We'll see what happens. I have a few months left.
Everyone's applied.
Yeah.
I'm going to pin that to the top of my Twitter, my X feed. Guys, I think that's about it, all the time we have today. Thank you all for coming out and listening to
Thank
this.
you.
I
Thank
learned
you
a lot.
very much.
Thank you so much. We appreciate
Thanks,
your
Sean.
insights.
Thanks,
Take care,
Sean.
everyone.